Good afternoon, everyone. I am Aditi Sanghi. Today I am here to deliver a presentation on new fund offer NFO. So let me start by introducing this topic to you first. What is NFO? A new fund offer refers to the initial sale of fund shares issued by an investment company to investors. A new fund offer occurs when a fund is launched, allowing the firm to raise capital for purchasing a securities. The initial purchasing offer for a new fund varies by the fund structuring. Issuing price for NFO generally would be rupees 10. Once the NFO closes, investors can purchase fund units at the prevailing net asset value (NAV) of the mutual fund scheme. Moving forward, many people think that NFO and IPO are the same, but there are a lot of differences between them. I have listed some differences between them. So, uh, first is NFO is issued by fund houses, whereas IPO is issued by companies. The indivisible unit in for NFO is fund units, and for IPOs, it's share. The pricing level for NFO. Generally, NFO uh, would be of rupees 10, and it is irrespective of the underlying companies, whereas IPO is influenced by the fundamentals of the issuing company. And NFO will be available for the public investment on the respective websites of the fund houses, whereas IPO will be available for subscription only through the recognized stock exchanges. So, in conclusion, we can say that an NFO to a mutual fund scheme is what an IPO is to stocks. Moving forward, types of NFO. There are three types of NFO: open-end NFO, closed-end NFO, and exchange-traded NFO. First, let us talk about open-end NFO, open-end funds. So the number of shares in open-end fund are not limited, and they are not traded on exchange, and they are managed by the fund companies. They report their NAV, net asset value, daily after the markets close. Offer when NFO term periods ends and before NAV is determined. Closed-end fund, they are highly marketed as they issue limited shares during their NFO and they traded on exchange. Investors can buy it through a brokerage firm and they offer when NFO is released. Exchange traded fund, they are the investment fund that publicly traded on stock market. Moving forward, types of equity mutual funds. So first is large cap funds. As per SCBI's mandate, large cap funds must invest at least 80% of their assets in large cap stocks. The rest can be invested in mid cap, small cap funds. So next is mid cap funds. As per SCBI's, mid cap funds must have at least 65% of their assets in mid cap stocks. Small cap funds. Small cap funds must invest at least 65% of their assets in small cap stocks. Dividend yield funds, they invest in high dividend yield stocks and they are thought to be less risky as dividend yield funds are mostly have a business stable business growth. That's why they are less risky. Next is value funds. They practice value investing strategy and they invest in companies which are trading at a discount to its intrinsic value. In this, the fund managers analyze the company very deeply to uh, get its intrinsic value. Moving forward, so should we invest in a NFO or not? So I've listed down the advantages and disadvantages of investing in an NFO. So first is opportunity to invest in a new scheme, no large flows, flexibility, expert knowledge, as NFO is handled by our fund managers. They have the better knowledge in comparison to us. And last is lock-in supports. Disadvantages, uh, no track record. As NFO is issued first time, so we don't have the opportunity to guess uh, whether we get as a high return or not. Then higher expense, lower degree of diversification, and not like IPOs, as I've already explained. Moving forward, so let me end this presentation by by a thought of Warren Buffett that risk comes from not knowing what you are doing. Thank you.